Certainly don't call it a comeback because it's not. Well, not yet. But many big tech stocks that got walloped to start the year are trying to claw their way back. So, is the move last couple of days the start of something bigger? Your guess says probably not. Let's bring in Chris Veroni of Strategic Research. Chris, what say you?
Hey, Brian, great to see you. Happy New Year. Well, listen, I think this is a big moment. I mean, we've had this 8 or 9% correction in the Qs. Now we've had about a 4 or 5% rally over the last several days. And the question we're posing is this the same as all the other correction from the last 18 months where it was relatively short-lived and the market bounced back and you went on and made new highs? Or is this a little bit different? And right now, I think it's actually a little bit different, both internally and from a macro standpoint as well. So I brought along some charts. We'll first start with the internal complexion of the triple Qs. And this, I think, is the big difference. The prior corrections you've seen over the last year and a half, you always started them with 95% of stocks above the 200-day moving average in the triple Qs. We started this one with about 60% of stocks above the 200. And this rally the last couple of days really hasn't changed that at all. So the internal makeup of this market is still weaker than we've seen at any point over the last year and a half. When you look at where this can rally to, 390 is a big level. I would be a little careful here. I would be more prudent. I'd be taking some off the table as triple Qs rallied into that big level around 390 because the internal complexion of this market is just not as technically sound anymore. And then secondly, I think the macro environment is dictating this shift as well. The second chart we brought along, I think, is a good one. It's showing the rise in real rates versus value tech versus growth tech. And what we've seen in the past is that value tech tends to outperform the growthier tech names when real rates rise. And we're in the camp that real rates will continue to rise here. So I think within tech, if you're going to play here, you want to emphasize the more value-oriented names. And then on top of that, Brian, the dollar has rolled over here. It's our third chart. And weaker dollar has tended to bring along with it a more value interpretation as well. So I think there's two sides to this trade. If we're looking for names we can own that kind of have the value orientation, look at something like HPQ. It's a 10 multiple name. It's not expensive. It pays a 3% yield. It just broke out of like a 20-year base. I think any pullbacks on a stock like that can be bought. Conversely, something like NVIDIA, which is on the other end of the spectrum, growth tech, actually is not acting that great here. Has not made a new high in about 6 or 7 weeks. This rally's been pretty tepid. I think there's some risk there.
Chris Veroni of Strategic Research making some really interesting points on big tech. Chris, thank you very much. Tim, I don't know about you. I don't want someone to ever say about me, that's Sullivan, he's all right. Not technically sound, but otherwise okay. That's kind of what Chris just said about the QQQ and big tech. Can you own big tech in a rising rate environment?
Yeah, and we've never said that behind your back, Brian. I think you have a case here where you've got, first of all, his argument to me was to own the top 5 tech companies in the world because largely they are value plays relative to, maybe not to an HPQ, maybe not to an IBM. And again, I think there's reasons there. But I think the argument that, first of all, if you look at the triple Qs, they've been wrestling with the 100-day moving average for only the 4th or 5th time, really, since the bottom the bottom of March 2000. And I think you've got a case here where those internals really, we've been talking about them for a long time. Below the surface, it really is an ugly scene, and the high multiple stocks will continue to underperform. If you're looking for value in mega cap tech, I think we've talked about this, but I love Cisco. I love the valuation. I love the transition of their business into more of a software recurring revenue story and around security, et cetera. I think Intel is a longer play and obviously requires more faith. But again, these are two names that I think you really can feel are value tech.
Yeah, and Guy Adami, I mean, we got to break out the way back machine. When is the last time on Fast Money somebody has recommended Hewlett Packard, HPQ, but it's got a 7 trailing and a 9 forward PE, a decent little dividend to thrown in, and probably not a high-risk company. Your take?
Yeah, and it's interesting, people are now flocking to names where they can wrap their arms around valuations. I mean, if you listen to what Chris said, the technicals that he's talking about backs up some of the arguments that Steve has made now for the last few months. I mean, that's where people are going. So they might not be the sexiest names in the world, but they're getting the job done. And I'll throw Oracle in that mix as well in terms of a company whose valuation makes sense in this environment, has sold off from that recent high post-earnings, making an acquisition, and I think it checks the boxes that Chris was talking about.